Not all income is taxed the same, and that's a game changer. Two people can earn the same amount, but one pays double the taxes while the other builds wealth quietly. The difference: earned income versus capital gains. One's taxed like hard work, the other like smart ownership. Ever wonder why founders, investors, and real estate tycoons get rich faster? They focus on assets that grow, not just paychecks. In this video, we'll break down what capital gains are, how they differ from wages, how the tax system treats them, and why the wealthiest people structure their lives to maximize them. Welcome to Finance. The IRS sees income in three buckets: earned, portfolio, and passive. Each is taxed differently, and the gap is huge. Earned income, think salaries, freelance gigs, gets hits hardest. In 2024, federal income tax ranges from 10% to 37%, plus a 15.3% payroll tax for Social Security and Medicare if you're self-employed. Capital gains, from selling assets like stocks or real estate held over a year, are taxed at 0%, 15%, or 20%, depending on your income, and skip payroll taxes entirely. Qualified dividends often follow the same low rates. Passive income, like from rentals or limited partnerships, can also dodge heavy taxes through deductions like depreciation. The result: a high-earning employee might lose 40 to 50% to taxes, while an investor pays closer to 20%. IRS data shows the top 1% get over half their income from capital gains, dividends, and business profits, not salaries. Let's see this in action. Imagine two people earning $200,000 a year. Person A, a doctor or lawyer, pays about $45,000 in federal income tax, 24 to 32% effective rate, plus $15,300 in payroll taxes if self-employed, leaving them with roughly $140,000. Person B earns the same $200,000 by selling long-held stock, taxed at 15% capital gains, $30,000 total, no payroll taxes. They keep $170,000. That's a $30,000 difference for the same income, just because of how it's earned. The wealthy amplify this by structuring income as capital gains. They take equity over salaries, use strategies like buy, borrow, die to avoid realizing gains, or leverage exemptions like qualified small business stock, QSBS, for up to $10 million in tax-free gains. Warren Buffett once shared he paid a 17.4% effective tax rate on $62 million, mostly from capital gains and dividends, while his staff paid 33 to 41% on salaries. Tech founders do this too: low salaries, big equity bets, taxed lightly when sold. Even on a smaller scale, a freelancer earning $100,000 might lose 30 to 40% to taxes, but someone who builds a website, holds it for 2 years, and sells it for $100,000 pays just 15% and skips self-employment tax. Miss this, and you're working harder while keeping less. Inside the ALOX app, we guide you through building and keeping wealth with thousands of lessons and expert-led courses on topics like private equity and personal branding. Download the app, scan the QR code, and get 25% off your annual membership to start your wealth journey. Let's dive deeper into capital gains. Capital gains come from an asset's growth, not your effort. Buy stocks, real estate, or crypto. Sell later at a higher price. That profit is a capital gain. Short-term, under 12 months. Gains are taxed like regular income, but long-term gains over 12 months get preferential rates: 0%, 15%, or 20%, based on income. For 2023, the top ordinary income tax rate was 37% for earnings over $578,125, but only 20% for capital gains. That gap is a massive advantage for wealth builders. Picture this: you invest $100,000 in stocks or a private company. 5 years later, it's worth $180,000. Sell it, and your $80,000 gain is taxed at 15% if your income is under $492,300 married filing jointly, costing $12,000. A worker earning $80,000 pays $13,000, $17,000 in taxes while grinding full-time. Investors also use tricks like tax loss, harvesting, selling losing assets to offset gains, further lowering their tax bill. This system started in 1921 to encourage investment in businesses and property. Lower taxes on gains meant more people would invest, fueling growth. Today, it's a cornerstone of wealth building. In the U.S., capital gains are taxed far less than wages. Globally, it's similar. The UK taxes gains at 10 to 20%. Germany skips taxes on assets held over a year. Australia cuts long-term gains taxes in half, and Singapore has no capital gains tax. Labor gets taxed heavily. Ownership gets a break. The world's shifting toward rewarding ownership over effort. Since 1970, workers' share of U.S. economic output dropped from 64% to under 59% by 2023. While business owners' share rose, the S&P 500 grew over 1,600% since 1990. But real wages crept up just 18%. Tech and AI accelerate this company's scale without more workers, making jobs less secure and salaries stagnant. A 2024 survey found 25% of workers fear their job will vanish in 5 years. Assets, though, keep earning without burning out. IRS data shows households earning over $1 million get just 17% from salaries. The rest is capital gains, dividends, and investments. Jobs are a start, but real freedom comes from owning income-generating assets. The tax code rewards this, and it's the future of wealth, not more hours, but smarter ownership. Thanks for joining us, Alexa. See you next time.